with that, I'll just go right into the pop quiz. Let me put the pop quiz chart up. I'll leave it up for 5 minutes, take a picture of it, mark it, and then we'll go over it together as a group. These are my test slides. Okay. I have 2 of them, but we'll do this one. We'll go from there, okay? I'll be quiet for 5 minutes, if at all possible. It's 6:02. I will pick back up at, no, 6:03 now. I'll pick up at 08, and then we'll talk about the chart. Label it. Let's start all the way over here. This is Friday. This is non-farm. Should not have traded, but a lot of you did anyway. Okay, look. Look at this pattern to the low. This is simply a W formation where the dealer hits the stops in the shadow box, but he hits them late. It's a reverse W, so to speak. So what happens is he traps, pulls back, traps, and then using the news as the trigger, hits the stops to the low side, rises up for the day, makes the formation, and ends the day back in consolidation. Same shit, right? You're analyzing the last 3 to 5 days of data always. The news messes up the cycle. So in essence, the news, because it whipped both ways and hit the stops both ways, we use it as a reset. Okay, so now, what's the dealer going to do tonight? Well, I can tell that the retail trader trend is up. And on day 2 of the cycle, he lines up the retail trader technicals. So if you're not sure what to do, this is a good day to stand aside. Okay? Now, when he rises on day 2 and confirms that he is in an upcycle, I know what to expect last night. He is in day 3 of the cycle. He makes a beautiful stop hunt high outside structure. Trap, 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 trap pins. Hit him again. Hit him again. Correct big to make my money back. Right back past the mayonnaise. Okay? You can take this trade here. A lot of you did. Back in to end the day. Now tonight, that's the end of the reversal. Steve, is the dealer going to reset or continue? I don't know. Let me see his behavior tonight. If the dealer comes out, here's your W, and he trades above and stop hunt low, we expect him to rise. If the dealer comes back to this level and gives us another W and does not break this level, we expect him to rise. If the dealer breaks high first, back towards this peak, if he does this tonight and makes another formation at the same level, that would be a 22 trade. Okay? I played this for you guys before, but there's a song, When I Move, You Move, for you new guys. When the dealer makes his move, you react to the dealer's move. When I move, you move. You analyze his behavior. When he moves and shows you his hand, what he's going to do, then you make your move. Okay? I can't show you a better W than that. That's pretty decent. I mean, that's really pretty. Look at the pins. Pins switch to the downside. The pins switch to the side the dealer's trying to trap. The pins switch to the side the dealer's trying to trap. Don't you see it? To me, it's blatantly obvious. Look, the pins switch to the side he's trying to trap. Because he's reaching down there. Remember the money grab? He's reaching down there with his hands, snatching a handful of money and pulling away and closing the bar off of there. He's closing up in here. But he's snatching down here, opening the spread, and there you go. How many fingers does this guy have? I don't know. There's his little greedy hand right there. That's what he's doing. Imagine that. Okay, let me give him some fingernails. Maybe it's a chick. Let me change the color. How about that? My wife wears that bright red nail polish. Drives me insane. In a good way. I love it. Alright, how about that? It's a girl. It's a girl market maker. Alright? The hand is reaching down there. Oh, they got a red finger now. All right? The hand is reaching down there and grabbing up the money. Remember that. When you see the pin switching to the downside, that's what's going on. Look. Pins to the downside, pins to the top side. It's a money grab. Okay? It's a money grab. That's their job. But the best trade was the outside structure to the high. Dealer held the level all through Asia. He pinned it late session and then corrected. And it was an easy take right here. That's where he took profit. Okay. All right. Everybody see this stuff? Hopefully you are. This W, look at this W. This is the opposite. This is the mirror reverse of this. The dealer spiked high and induced, then pulled away and trapped the traders and held long. And what he did here is he trapped low, waited for positions to build, anticipated them building long, used the news to trigger. This was non-farm payroll release. Used the news to trigger. It's the exact opposite. But it's just variations on the theme. That's all they got. They do the same things over and over and vary the theme slightly. That's all. What did I tell you about this? If the dealer extends the low and closes back above within 30 to 45 minutes, he will rise. If the dealer sets the high and closes back below in 30 to 45 minutes, he will correct. Two perfect examples of that. All right, hope you're starting to see this stuff. All right. Candlesticks. All right, so where are we in our process? We understand the dealer cycle. We understand the 3 days of levelization. I want to talk about where we are in the process. I didn't forget about the quiz. I have some videos for you. I don't know if it's going to be tonight or tomorrow. We're just going to get through it. So here we go. Okay, where are you in the process? You should understand the cycle. I talked to you about how the dealer sets the trap, the M formation, the W formation. What I want to do today is I want to break the M's and W's down and show you the type of candle patterns and the things that are made, how the pins come into play, how the outside structures, what the dealer does to trap you. All right, so breaking down the M's and W's, how do you break down and look at the individual segment, right? Like we talked about on the flashcard. We need to analyze when the dealer does this. We need to analyze what the candlesticks that he presents here, here, and here, what they appear and what they look like. Right? It's analyzing the behavior of the dealer. Understand that the candles are the damage, the footprint after the damage has been done. When the dealer throws a candle up there and closes on a pin, he already got the orders. The damage is done. So we have to look at certain types of candlesticks that appear at the high or at the low during these volatile times. Okay, the times when the market behavior, according to regular people, is inexplicable, not understanding what's going on. So at these segments of the cycle, you have to identify the market condition, because candles, to me, in the wrong market condition are meaningless. I know that Steve Nissan will tell you, man, this guy's crazy when he's talking about. I could tell you that I could look at any run and I could see hammers and spikes and dojis and garbage. To me, I ignore those because I know that the dealer is trapping along the way and hitting the stops of people along the way. I understand that as part of the business. My only concern in the business is what the dealer does at the high of the day and what the dealer does at the low of the day. I don't care what the candle looks like. I understand that if the dealer spikes the high with a vector candle and comes back below that high and goes into accumulation or consolidation, then I know that I more than likely have the high of. It's his behavior by the second leg that is going to lock that trade for me or make me question it. Okay, so what I'm talking about is the dealer does this. I'm pretty sure that I'm staring at the high of the day right now. Now I'm waiting. How long? 30 to 90 minutes, up to 2 hours. I'm waiting for him to exhibit some type of behavior that guarantees this trade is a lock. That behavior is a hammer, a pin, a spike back towards the high and fail to take the high out, or a spike above that high and come back below within 30 to 45 minutes, which would set off divergence on the TDI or whatever indicator you're using, which gives me the confirmation as part of the cycle. The confirmation as part of the confluence of events that I mentioned to you has to happen. You got to have a less than a 50 pip channel here. Man, that's a horrible 5. Looks like a 7. See if I can salvage that. Hell no, there ain't no salvaging that. All right. I got to make sure he made a 50 pip channel. He vectored 3 to the high. I saw him extend the high in 3 beautiful bursts. The high was extended by 25 to 50 pips. He pulled back off of the high after it was set, and he went into consolidation. Now, his behavior next gives me the clue. That's a lock. If he ends on a hammer. If he spikes above and comes back below, that's a lock. So, what do I expect to see? First leg and second leg, I got to see some spike candles, some spinning tops, some dojis, some railroad tracks. The high test and the low test has nothing to do with gasoline or aviation fuel. High test is when the dealer comes back to test the high. And when he tests the high, it's not really a test. It's a money grab. He's grabbing the orders that have built up since he pulled away. So he would appear to be testing the high. That term was coined from the New York group, and I like it, so we left it in there. But understand what it means. When you retest the level, the dealer is not in the business of testing anybody. He could care less. He's in the business of grabbing money. So when he repeats a level, it's because he's like, holy crap, there's another $500 million sitting there. I got to go get it. So he will come back and get it. Okay, low test, same thing. He establishes the low, comes back near the level. He either breaks it and comes back above, or goes near it and uses his edge, the spread, the dealing spread, to grab up those orders. Okay? So, what we have for our purposes, and this group's purpose, is we have what we call vector candles. A vector, by definition, means something of magnitude, length, and direction. Okay? So, what are we looking for? We're looking for what's deemed in the business. Okay? To help your thinking. It's deemed in the business as a momentum candle. Oh, that breakout momentum candle. Momentum is usually the stop hunt by regular textbook definition. Remember, in Forex, the fast move is usually false. The fast move is false. It's a move created on light volume by the dealer to pick up orders, to get the ball rolling, so to speak. It looks like, the vector candle looks like a burst in price. Retail traders call them momentum candles. They couldn't be more wrong. If you're staring at a chart, and I got this from my friend Zaim, who did some extensive work on my program. He said, you'll be looking at the chart, right? And it'll be normal, and all of a sudden it'll go like that. And he said, if you back up and look at it, you would say to yourself, man, that shit ain't right. Don't look right. So out of nowhere, when you stand back and stare at a chart, and you see these big spike candles, or these breakout candles as they're called, you have to go, man, I see that. That's not right. It's coming out of the box. It starts the action. The reason that the dealer does this, it appears for no reason other than to start the session or get things rolling, to get the ball rolling. Remember what I said, in order for me to get you to click your mouse, I got to break out, I got to do something. I got to make something happen in order for you to click your mouse and spend your money on me so I could take it from you. If that money's deposited in the account and you don't click the mouse, it's worthless. So what do? I go, all right, let me give these schmoes a bunch of breakout traders. They'll take it. A bunch of breakouts. They'll take it. I'll swing it the other way, break out the other way. And then I'll do what I was going to do anyway. And in the meantime, I pick myself up a couple $100 million. My bosses are happy. I get to go buy G.I. Joe with the Kung Fu grip. You know what I'm talking about, okay? Usually the vector candles will form the first leg of the reversal pattern. It's the start of the show, so to speak. It's the start of the M or W formation. Okay? This is what I'm talking about. Here is the initial low of the day, the ILOD. The dealer, in one swipe, aggressively breaks the low, taps it, holds the level, hits it again, holds the level for 15 minutes, hits it again, and comes back above the previous low. Closes on a hammer. That, my friends, is a decent entry. Here, or confirm when he crosses over the mustard. Notice how he comes back. This candle was solid red at one time. He comes back and then closes way above. What he did was, this was your low retest candle and your shift bar, shifting the zone all in one 15-minute period. The dealer came back, retested the low. Don't forget, you're like, Steve, he's quite a few pips off the low. Yes, but he can open the spread and get anywhere in here and grab those orders. Okay? All right, same thing. The opposite of the W is the M. Here you go. You got the Asian initial high of the day. All right? The dealer extends the high in 3 bursts. Now, I know there's only 2 candles forming the high, but if you understand the drill, I'll talk about it. The dealer will burst the high or burst the low in 3 pushes or swipes. Sometimes it's 3 perfect candles. Sometimes it's 2 candles within each one has a burst. And what will happen is the dealer will push the high quickly. See how in one swipe he extended the high. This is a breakout. A breakout candle right there. That's the traders took that. So a break plus a close, they went long here on the open, okay? So now, what happens, 2 and 3 can be contained within this candle. The dealer can burst up, hold the level, pulsate, pulsate, pulsate. That's when the board flashes and nothing's moving. Pulsate and then hit it again, be the 3rd burst. That's why it's labeled as such. He closes in a railroad track formation right here. He comes back, picks up the stops. He goes all the way back to the high, taps it. Any orders that are placed here with the widening of the spread are now absorbed. And then he comes right back below and it's over. He's on his way. This candle means nothing right here. See that candle? See that hammer? This is what I was talking about. Candles in the wrong segment of the range mean nothing. Does that doji mean anything to you? It doesn't mean nothing to me. It's garbage. The candles that mean something are the candles that form the high and low as part of the structure. That's the candles that are meaningless and telling. Because what I was taught, when I was trained, and you guys, the regular students know this, the new guys, this is for you. I never looked at a chart. And when the guy told me stop looking at a chart, I think I almost had a nervous breakdown because I'm like, don't look at a chart. How do you know what to do? Do you just pull it out of your ass? What do you do? Well, we looked at the big board. The big board is the bid and the ask and the high and the low and the time and nothing else. It's price. But the takeaway from that is the dealers don't give a crap about the chart. The chart is the aftermath of their behavior. So if you understand that this doji in here and this hammer over here and this spike candle in both directions, it means nothing. It's not oh, the Bulls and the Bears won. Hey, they duked it out, and I could care less about it. Garbage. Really, in 15 minutes, the Bulls and Bears duked it out, and the entire market was decided on that one candle. That is a retail trader's bullshit story to make you feel better. To try to explain what the candle is. The only thing that I care about is what the dealer did at the high of the day and the low of the day. Everything else in between is fluff. Okay? You're looking for a particular behavior at the high and at the low. And if the dealer issues these particular candles at that point on the chart, then you got them. Think about what I'm telling you, okay? If this candle shoots up here and forms the high, and it's 3602, just a random number, and this number's 3602, and the dealer comes back to 3602 and extends it to 3605. If it's 3605 by 7, if it's a 2-pip spread, but if he extends the spread by 10, it can go as high as 3615. So his reach is extended to about where people put their stops. To understand that opening up the range or the spread is their tool that picks up pending contracts or orders that are outside of their reach. You may or may not see this going on your dealer, but it is in fact going on. So what would happen is that if you bought here and you see price around here working, this side, the buy side, will be held, and the ask side will be extended to pick up the orders. And these people will never see a profit above here. So they'll be -5, +5, screwing around back and forth. But in the meantime, they're picking up the sell side of the contracts. Okay? That's what you have to understand what's going on. That's the widening of the spread. That's their tool. And I told you what happens is it comes near the high, right? You have a 2-pip spread all the way. And then when it gets to the high, it extends out like this. It extends his reach, and then it comes back calm. Terrible drawing, but you get the point. Is that the spread normally should be like this. But he whips it around and picks up and blankets any amount of orders that are aggregated in here. Okay? Shows the dealer's intentions. Alright, sneaky. I erased it all in one shot. Okay, so understand. The vector candle, a breakout candle, in one swipe, and then you could say that this pump and pullback is 2, and then he swipes it again 3. But what you're looking for is 3 bursts, and I'll illustrate exactly how I was taught in a second. Candles represent where the price has been. When a candle paints, the damage is done. Market makers have gotten what they needed, and they're on their way. Okay, to better understand the process, let's break it down and look at what the high-low board might look like. Okay, this is the way I was trained. Okay, I did this a while back when GBP was a little higher, so let's say this is the price point. Okay, 61.60. And let's say by 63 or 62, say a 2-pip spread, 62. Okay? You have your initial high of the day. You have your initial low of the day, but we're going to explain the high. And it's just habit for me. Okay? So now, he does his normal thing. He breaks out in one swipe. And he extends the 61.60 by 24, 25 pips with the spread, 24 by 26 pips. He extends in 3 bursts. 1, 2, 3. I'm going to switch back to black, okay? Okay, so in 3 bursts, he extends the high by 24 pips. 24 to 26 pips with a 2-pip spread, right? Or 60 by 62 is what the quote is. Okay, so He hits 61.84, which is a 24 by 26 pip extension. The initial high is canceled. We are now at the high. Hi, how you doing? Okay. The dealer pulls back. What's 70 minus 84? 14 to 16 pips. Let's just, for argument's sake, let's say he pulls back 15 pips. All right, put it in the middle. It's easier. Okay? He then goes back towards the number. And what he will do is, you'll have 61.84. He'll go from 61.70 back to 78, which is about 6 pips with the spread off of the high. So in the meantime, if you were watching the big board, which is what I was trained, you'll have your bid and ask, and on the board you'll have your high and your low. And you'll have your columns. You'll have 4 columns. Okay? And you'll have price over here. And you'll have the high was initially 61.60. Should have picked like 111 or something. 111. It would have been easier to write, right? You have 61.60. The low, let's say the range was 30 pips initially. And let's say it was the low was 61.30. Okay? So the low is untouched. The 61.60 will get changed immediately in 3 bursts. It'll go from, say, 61.60 to 78. Right? The number will change. Then it'll go from 78 to 80. This is the 3 bursts. Then it'll pull back a little bit, and then the dealer will come back and he'll go, I was joking around and go ping, he'll hit it one more time. He'll go to 84. So what happens is, the 61.60 was extended to 84 in 3 pushes. That's where this comes from. That's where I was taught that. Sometimes it will be in 3 candles. Sometimes it will be in 2 candles. It will be immediately. Sometimes it will be in 1 candle. But as part of the boot camp, we will work the big board, and this is what you're looking for. You're learning to see this. Okay? Now you'll see the price from 61.84. The high will be set, and now you're watching these numbers, and you look for the pullback off of 61.84 to 70. What is he doing? He's getting people to go long. Right? They went long. Now he comes back and he hits the stops. At the same time, some aggregate of people also went short. The people that went short, right, pretend there's some balance of long and short in here. He's hitting the stops. And now he's coming back in here, and he's taking out the stops of the people that went short. Because why? Everyone puts those crappy 5 pip stops below their entry. Don't want to lose too much. Right? So now, he's managed to induce long, stop them out, induce short, stop them out, come back for anybody that says, oh, if it breaks above 84, I'm taking it. Comes back, opens the spread, grabs those guys up, pulls them back in, and drags them down to about 78, which is just enough off of the high. Now they're trapped. He's got them. Every time that he makes this move, he's reanalyzing the volume. Think about this for a minute. He is, in essence, making money. So every price point along the way, he comes in here, he's like, what do I got? Okay, I picked up 500 mil. All right, if I stop these guys out, I'll book 300 mil. If I go back and run up, I'll pick up 200 mil. If I go back here, hold, grab the rest of those orders, I'll get that last 100 mil. I was told I need 900 by the end of the day. 5 and 4 is 9. I'm there. Okay, I can correct against those guys. I got what I need. Thank you. That's what he's doing. It's not about, oh, let me make a pretty doji for the retail traders to take that short. That's not what he's doing. He's behaving in such a way that makes him rich and lines his pockets, but this is what it looks like when he's done. He doesn't care what the candles look like. It's not for him. The candles are for our benefit to try to understand. The bulls and the bears aren't duking it out. The dealer's taking everybody's money and laughing. So what's happening in essence is that he has rounded out his book or balanced his book for what he needs, and then he corrects against those people that are holding the net long positions. If for some reason the positions aren't right, then he will go into continued consolidation here, and then it changes everything. That's where the 2-hour time stop comes in. If you pull the trigger on second leg, what's the time limit? 2 hours. If the dealer doesn't shift the zone in 2 hours, something's wrong. Well, what could possibly be wrong, Steve? The greedy bastard didn't make enough money. That's what's wrong. Nothing else is wrong. He didn't get what he was ordered to get or take from the retail trading world, so he has to hold that level and reanalyze the book. Now, when he's holding that level, there's only one or two things that can happen. He will hold that level and handle a cross, a pair comprised of the major he's working, or he will extend the high further before shifting the zone. Okay? And if this is a W, he'll extend the low. So what he'll do is, he'll vector again outside to here, and he'll rise, close above, and he'll make his trek 25 to 50 pips higher. Why 25 to 50 pips higher? Because that's where people put their stops, number one. And number two, that's what it takes to make you feel like the pair's running away from you. If you see Euro and you were thinking, oh man, it's going short, you take a short position, then it breaks higher, you're going to be like, I'm missing Euro, and you will jump on making an emotional decision trying to grab you some Euro today. And then he'll put the brakes on and elicit the same behavior again. He might just go up quickly, 25, 50 pips higher, railroad track, and come right back down. But understand, this is what he's doing. The candles, I look at the numbers, I never looked at the candles. So the candles are a benefit when you understand it from this perspective. Looking at a doji or an evening star or morning star doesn't mean anything until you understand the numbers. Okay, an evening star, what is it? It goes up. Okay, and then what does it do? It consolidates for 15 more minutes at the top. And then it comes down. Right? Someone will tell you, that's indecision between the bulls and the bears. No, it's not. They know exactly where they're going to take it. It's 15 more minutes of taking your money from you. That's all it is. And when you see it from that perspective for what it is, if you didn't look at this, and the dealer takes 61.84, and he holds 61.84 by 86, and he holds it for 15 minutes, to me, in dealer speak, he's holding the high. Why would he hold the high? To induce traders to go long. Okay, so he went up, he set 61.84 by 86, he holds 84 by 86, holds 84 by 86, damn, he opened the spread to 90, 84 by 90, 84 by 92, 84 by 94, damn it, he's picking up those orders, 15 minutes, he's got him, back to 61.84, the spread comes back together, he calmed down, okay, he whipped it back, he went 84 by 90, he's come back down to 84 by 86, he got what he needed, he's 84 by 86, he's going to correct now. There's your second leg of your evening star, morning evening star formation. Then he starts to correct. Second railroad track or second leg comes in. That's the correction. So when you look at it from this perspective, a numbers perspective, which is what I was taught, this is BS to me. Doesn't mean anything. But now, a lot of us grew up on this. We're trained on the candles. I was too. When he told me to throw my chart out, I started crying. I had a nervous breakdown. My wife's like, what the hell's the matter with you? I go, I can't look at the chart no more. What do I do? That's what happened when I looked at the big board. And it puts a different perspective on things. The dealer doesn't care what the candles look like. He cares if he's got 61.84 by 86, can I open to 90, 94? Can I pull back and calm it back down and get what I need? That's what he cares about. And this behavior takes up to 90 minutes, up to 2 hours, 30 to 90 minutes. A true M should take a minimum of 90 minutes. A good M or W should take a minimum of 90 minutes. An outside structure should take 90 minutes. The problem with the 30 minutes, and we have to account for it, is those damn railroad tracks, where he goes in one move, hits the number, and comes right back out. That's the problem. I have to account for that, because the minute I don't, you'd be like, Steve, what about railroad tracks when he goes in there and he gets right out of there? Okay? So that's what I'm talking about with the candles. Understand, from my perspective, or from our perspective now as a family, this is what we need to look at. It's the numbers. The candles represent the highest number on the chart with the wick, the pin, the hammer, or the lowest number on the chart. Same thing. Pick inverted hammer, or I don't know, the bottom's a hammer or the top's an inverted hammer. I don't know. But you know what I mean. The doji doesn't mean anything. The cross. It means that he went up there and grabbed the last few orders and came right back down. He went down, grabbed the last few orders, and came back up. That's what a doji represents. It represents the damage that the dealer does with the candles, which is price action. It's a mapping. The candles are a map of where the dealer has been and how he handled price at those points. So in essence, it's a dealer GPS. We can track the dealer by how he behaves at the high and at the low. When a candle spikes at the appropriate time and is used to extend the high or low, or the dealer's extending the high or low the appropriate time, 2 o'clock in the morning, the dealer makes a breakout candle, a spike, he's extending the high or low coming out of the Asian range. When it's pulled back, that becomes the high. I don't know that that's the high, right? When he does that and hits this number here, 84 by 82, or 84 by 86 rather, I don't know that that's the high of the day, do I? Hell no. Some of you take that short and then curse me out under your breath. And I know who you are. I've seen your charts. Okay? When the dealer makes this is my favorite. I'm not picking on anybody. I love you guys. Alright, look. You're in consolidation. It's less than 50 pips. Right? All the good stuff happens. The dealer widens the swing and does that. Okay? I noticed only a few of you admitted to this. The dealer sets the number right here at 61.84. And all of a sudden you guys short that. Oh, I short that. How the hell can you short that? Because Steve, I swore I thought I saw 3 bursts in there. 3 bursts is part of his behavior. It's not part of the signal. Okay, you do not short 61.84 when the dealer extends 24 pips. Alright? That is not what I'm talking about here. But until he pulls off of 84 back to 10 or 15 pips off of the high, 25 in some of the pound crosses, GJ especially, till he pulls off of that number, I don't know that that's the high of the day, right? How do I know 61.84 is going to stick until he does that? How do I know that he's going to go to 84, hold there for a second, and go to 95, 100? I don't know, or 200, the next level. I don't know that until he pulls away. When he pulls away, that's a clue for you guys to realize, okay, the dealer has pulled off of the high, and now he's working it. The market seems erratic, but it's not going anywhere. What does an erratic, non-moving market look like? Open the big board and just look at it during the London Open or mid-session, and all the numbers will be flashing when the dealer's forming the high, but not changing by very much. So the dealer will be at the high or at the low, and then what you'll see on the big board is red, green, yellow. Red, red, green, yellow. It'll flash. Green, green, yellow, green. It'll just flash, but price won't be changing. And everything looks like it's moving. The whole market looks like it's going crazy. You're like, wow, look at all that action. But if you write the price down, it's virtually unchanged. The dealer is working the highs and the lows when that behavior is present. Okay, so when you see that behavior, you should be like, all right, man, he's at those levels now. Let me see what he does. A spike to 61.84 or to 61XX, whatever, is not a shorting opportunity. Not yet, anyway. Okay, you have to understand that. So when he pulls back off of the high or low, it's formed. Now we got the high and low. He spiked up to the number. We have nothing at this point. Now, when he makes his descent off of that number, we have something. When market makers go near the level and fail to break it, you have your setup. That's how your M forms right in here. Okay? When he goes 61.84, when he comes back maybe to 78, maybe to 80, and fails to change the number on the high, you got him. And then if he ends this on a spike, hammer, or some type of pattern candle that gives us a clue that the dealer went up there, did his damage, now you know where you are in the cycle. And that is your entry. Here, you enter in here. After he makes the second attempt at the high and fails to break it. Robert, I'll discuss it. Okay? And then that starts the cycle for the day. Then comes the dealer shifting the zone. Hit the stops, drop, hit the stops, drop, hit the stops, trap to the downside, back into consolidation, right where the Asian session was with little to no net change. Okay? Cool. Okay, so the following candles need to occur where? Here and here. Everything else, as far as I'm concerned, is BS. But the presence of these at the high and low confirms the setup. It's part of the signaling process that we talk about. I said yesterday, a confluence of events that the dealer presents to you all at the same time that give you what you need. Okay, so it's going to give us high probability setups. We'll take a look at the candles. I think that's what I was saying. Yeah, so, the dealer spikes the low, pulls back, hits the stops, comes back for his second pass. With railroad tracks, there you have your entry. So, your low test candle where he comes back near the low, but fails to break out that low or break that low. Okay? Understand, this is no different. This is a price that was set. Okay? The low was 61.30. He pulls off of that low. He works it. He comes back, maybe 28. Comes near it. Maybe he's 28 by 30. He may or may not open the spread. And then he will come right back above that level and close. And there you have your setup, okay? Then what does he do? Hits the stops in one 15-minute period, and then he shifts the zone in one swipe. And that's the candle that puts everybody in this room into profit almost immediately. And if you shorted that, that's the candle, if you've ever had that knot in your stomach, that puts you down 25, 30, 40 pips in the blink of an eye, and you're like, what the hell just happened to my trade? Everything was fine. I shorted this, right? Think about this for a minute. You took this short. He held the level. You were +5, -5, +2, depending on where you got in. He came right here, and you were like, all right, +7, I'm there. Ah, shit, -7. Ah, it'll go. Whoops, just kidding. Now you're down big. And that's right, Mark. As to coin a phrase from my friend Lou, it ain't coming back, baby. Once the low is set, it ain't coming back for the session, the cycle, whatever the dealer has in mind. If that's the peak formation for the week, it ain't coming back at least for 3 days. Okay? So if you got jammed down there and got trapped and you felt that, it's time to feel the other direction now. It's time to feel the good side of this. It's time to feel the shifting of the zone. And when he shifts it away from the lower level shorts, you're a buyer, you get shifted into profit immediately. And you're up 25, 30, 35 pips, depending on how big the shift is. Okay? When does this trade become invalid, Steve? When do I get out of this trade? until your take profit is hit or the dealer comes back to the low and violates the level. Then you have to analyze where you are and make the decision, am I going to let this go to my stop, or am I going to cut the trade because the dealer has closed below the level, save myself the extra 12, 13, 14 pips, then I only need plus 15 to have a net positive day or greater. Okay? This trade is valid until this level on the board, okay, 61.30 is violated. The low of the day, 61.30, the trade is valid until 61.30 is extended. When 61.30 is extended, what's the solution for that equation? Did the dealer close below the level? Has the dealer come back above in 30 to 45 minutes? If the dealer has closed below and stayed below, I'm going to go ahead and scratch out, and I'm going to look for another set of circumstances or another confluence of events to take the trade. Okay? All right, cool. All right, so look what you got. This was the exact example of how the dealer extended the high opposite. He tapped it in these two candles. Count that as one tap. He then went straight up, changed the number in one swipe, and then what did he do? He went above for 3 and came right back below and ended on a hammer. He worked the area for 45 minutes. He ended on a quasi-hammer here, which is the second part of the M formation. Here's a good entry here, or a confirmed entry where the dealer is closed below the ketchup. Took a little heat here. Stop loss is right here, or right here. We'll talk about that soon. And then here comes the shift bar, baby. The arrow usually fires on the shift bar because that is the bar that forces the moving averages to cross over. If you are in the trade and that arrow fires, that is confirmation that price in this example is declining and that you're in a good place. You should be in profit when the arrow fires and the dealer shifts the zone because it takes a decent sized candle to make the averages cross. Okay, so the example here is that the dealer has issued a hammer, several of them actually. But I don't really care about hammers, except I care about hammers when the hammer forms the high of the day. I care about hammers when the hammer is the retest. Okay, I care about the pins when the pins hit the high and pull off. I care about pins when they come near the high and pull off. A better close here is red, but because of the distance of the wick, it's irrelevant. The fact is, the dealer is below the number. Remember I told you I care about the numbers. So in this example, the dealer set 61.84 by 86. He came back below it, about 15 pips. He went back near it. This perhaps would be the 61.78 by 80. Maybe he opened the spread. If there are any orders right in here, he wanted to grab them. He opened right here. He picked those up. Then he pulls away, closes on a hammer, shifts the zone, hit the stops, drop, shifts it again, lights out. And if you've ever been going the wrong way in that, it's a nightmare. Okay? All right. Yes, the arrow fires at the end of the shift bar. That's why it's too late to enter. This arrow will not lock until this closes and paints. Then the arrow will fire and the next candle will open. Correct. The arrow is not a signal. The arrow is a confirmation of a signal. If you use the arrows to get in, you're probably a good distance off of the low or the high, and it's going to cause you to have deeper stops. Okay? Yes, you have the crossover candle, which makes these two arrows cross right there, which is this candle. This arrow will not paint and lock until this candle closes and does in fact stay crossed or below the averages. In this case, makes them close. Your averages are like this, right? When that candle pushes it, it crosses over. So this candle this price action candle is what caused those arrows to cross. So until this closes and locks those averages closed, the arrow will fire here. but not until the 15-minute period has elapsed. Terrible arrow. All right. Looks like a mushroom. So at what point would you enter? Really? You know where I got in, don't you, Helen? I got in right there. I know, I'm kidding, man. You enter, if you're waiting for a second leg formation, you enter here or here. This is okay. Because that confirms a collapse below the ketchup is a confirmed entry. I want you to learn to understand the process and learn to enter in here. Either on this hammer or this hammer. Okay? The entry is on one of these candles. Why? The dealer established the high. He has not extended the high for 45 minutes, at least. Maybe 50, depending on when the high was set. And how long is the process? 30 to 90 minutes, up to 2 hours. This is one of those that the dealer hit it, worked it for a little while, shifted, went into, again, accumulation phase. This accumulation phase is accumulating longs. But in order to make his book, he hits the stops in both directions on these candles. Okay? All right, so pins. I want you to notice at the ends of the runs, very important, the pins will start to change direction and become unidirectional in their behavior and appearance. Okay, what do you mean? The pins will point in the direction that he's trapping. So when you see this, imagine in your own mind that he's faking this. There's arrows pointing down. Alright, imagine that these are arrow tips next time you see this. And he's telling traders, ha ha, go down. The pins will switch to a unidirectional point in the direction of the trap. So if he's inducing people to go short, he will push all the way down and pull back. These candles look like this because, remember, it's where price has been. They were all the way down here and they were red. And then the bastard pulls it all the way back and turns it inside out green. Okay? Now we talked about this the last minute. The last few minutes of the hour, the backside of the hour phenomenon, the last 2 minutes of the 15-minute candle cycle. This is what they do, okay? This is pretty shitty, but this is the reality. He'll have his number, okay? We were using 6130. It's easy for me to work with. Okay, the low is 6130. What he'll do is for about 13 or 14 minutes, he'll push this candle right here down to, let's say this line is 30 by 32. Alright? He'll push this candle all the way down red and hold it right at 30 by 32. So that candle will be solid red. See if I can erase this a little bit better. Better idea. Okay, let's see. This candle will look like this. It will be red. And it will be laying on 30 by 32. And then 12 minutes into the candle, 13 minutes into the candle, he'll pull it all the way back and end it like this. So what happens is, for 13 minutes, 5-minute chart traders, 1-minute chart traders, he showed you 13 little baby down candles. He'll push it down, you'll see 13 red candles if you're trading a 1-minute chart. If you're trading a 5-minute chart, you'll see 2 good solid red closes pushing to the downside. And then in the last 3 to 5 minutes of the candle, the dealer will start to snatch it away and turn it into a big fat wick and close over here. That's what he does. That's what they do. Start to watch that. That behavior is what makes the board freeze at 6130 by 32 or 6184 by 86. That's what makes the board freeze. So remember what I told you. This is the footprint of the crap that he did to people. This is the reality of what he's done to people. This is the footprint of that. Okay? This is the footprint, the remains, the remnants of what he did with this. Okay? So for 14 minutes or 13 minutes, we'll push all the way down a wick or a solid red candle. The candle will be laying at 6130 by 32, sitting there, sitting there, sitting there, and then all of a sudden, it'll close like this. That's a hammer, by the way. It'll close like that, and you'll be like, what the hell just happened? He went from 6130 to maybe 48 by 50. He pulled away and left the wick. That's what it means. It's about the numbers. Right? When you show me the numbers, hopefully putting the numbers to this behavior makes you understand that he doesn't look at candles, he don't care. He cares about where are the stops, where are the net longs versus the net shorts, what does my personal book look like? Because his book is a microcosm of the entire market because he's the dealer. So if his book is a certain way, all the other dealers' books are about the same. Okay? So that's what I'm trying to get you to understand with the pins and the railroad tracks and this stuff, okay? He goes in, grabs the orders, comes right back out. Okay? Second leg. Evening star formation, I said it already. It's 15 minutes of beating you up. Has nothing to do with, wait a minute. Don't say it. Don't say it. I got you. Yellow. It's 15 more minutes of grabbing up orders. It is not a battle between the Bulls and the Bears beat the Bulls 3-1. It's not what's going on here. It's the dealer goes in, he works, he puts the number at 84, and he sits there 6184 by 86, and sits there for an extra 15 minutes right at the high of the day. When you start to work the big board, you will understand this. He will open the spread and grab the orders above those numbers. There's a big fat hand. Terrible artist. Not my forte. Thank God I'm a trader. If I had to eat off of this, we'd all be poor. All right? 84, open the spread, grab the orders above here. That's what he's doing. And that's it. Okay? This evening star, morning star allows the dealers to hang around for an extra 15. Railroad tracks, in and out. I've talked about it already. It's a 15-minute in, 15-minute out. This 30-minute anomaly makes us have to be short on the cycle. We have to say 30 minutes. 90 minutes to 2 hours is a way better establishment of the high and low. Those are clean, pretty patterns when the dealer holds those levels for longer periods of time. Okay? You'll see what I mean. Okay, the definition of these candles. I know we went past. We'll get a break here in a minute. I'll knock out these definitions and then we'll break. The doji. The high of the day and the low of the day is held for an additional 15 minutes. Allows the dealer to flash across or grab a few more contracts. This is our market maker definitions of what these patterns are. Evening star, morning stars. Hold the level, open the spread, induce traders to take continuation trades. And again, to grab more contracts. All right, is audio still good? Hammers, inverted hammers. Okay. A couple people put it up. I think it's them, right? The storm blew over, so we're good, man. Hammers, inverted hammers. Used to activate the pending orders that are sitting. Trigger the stops, obviously, like I showed you. And basically grab up. It's about the money. It's about grabbing the money. I showed you the hand. That's what they're doing with these patterns. Spike tops, spike bottoms, trap and create drawdown. They create immediate drawdown and panic for the traders. By spiking down there really quick and pulling it back, in essence, what happened? You got jammed down there and you went into immediate drawdown. Immediate drawdown is a panic tool that they use to get you to do stupid things. And the stupidest thing you can do when you get into immediate drawdown is remove your stop loss order. And that's what they're counting on. When you do it, they know that's just a matter of another day or two. When they run their cycle, they're going to put you in major drawdown and either flash you out or make you take a big loss. Railroad tracks, get in, grab the money, create immediate drawdown and panic, and get the hell out of there. They go in, one leg, grab the money, they get out, create drawdown and panic. That's what a railroad track is. Okay? Market makers induce traders to take wrong directional moves by sharp, aggressive price changes at or near the high or low of the day. These patterns always reveal a reversal setup. And then again, it's about the book. Why would this fail? Why would the dealer show an M and then extend the second leg of the M higher? Because trap volume does not meet the total value they were seeking. So that's where the 2-hour time cap comes in. The 2 hours is not negotiable. The 2 hours will save you out of a lot of trades. Because here's what happens. The dealer goes up, hits the level, pulls back, and he doesn't shift the zone for a couple hours, 2 hours. If the zone is not shifted within 2 hours, maybe his book is out of balance. Maybe he didn't get what he needed. He did this, right? And you're like, oh, he's gonna correct, and he does this instead. If you took an entry here and it doesn't go into major profit and the dealer goes into consolidation for 2 hours, you are now gambling. If the dealer does not go into profit after 2 hours, you are now gambling. Here's the deal. If you're up 10 or 15 pips, you might as well take the scratch, because if you move your stop to break even with 10 pips, he's going to take you out. That's his job. Okay? 2 hours. Why 2 hours? Because that's about how long it takes for them to go up, make the formation, analyze the book, see what they got. Maybe he needed 300 million to the upside, 100 million to the downside, and maybe he came out with 2 and 2. And they told him 2 and 2 ain't going to cut it, buddy. We need 3 and 1. So his next move is going to be what? An extension higher. Or if he holds the level long enough, maybe to the U.S. session, enough people will buy into it, and then the book will balance on its own by letting natural market forces at work, by letting it sit there. So if the 2-hour time constraint comes and goes and you need to scratch yourself out, do not sit there and go, oh man, I see the M, it's going to go. This becomes a 50-50 proposition because you have no way of knowing what the dealer's holding. Is he holding net long? Is he holding net short? It's a gamble. We're not in the 50-50 business. We're in the high probability, strong confluence of events business. We're trying to increase your odds to the high 80s, 90%. And dare I say 100%, I'll get arrested, but people in this group are hitting 100% of their trades, high 90%, a month without a losing trade. Those are beautiful. Those things are unheard of in the business.